Alright, let's talk about stock split. What is stock split? Let's read from a source. After that, we explain. A stock split happens when a company increases the number of its shares to boost stock liquidity. This is not the only reason. Although the number of shares outstanding increased by a specific multiple, the total value of all shares outstanding remains the same because a split does not fundamentally change the company's value. Let's discuss. So when you're talking about stock split, it means when a company decides to increase the number of shares they have outstanding in the market, but the market capitalization of the stock doesn't change. Example, you want to divide a cake among 10 people, you need to cut it 10. While dividing it, let's say extra 90 people entered the room. You will now need to cut it into 100 different pieces. It means the number of the cake cut has increased, but the total value of the cake initially baked has not increased. So stock split is a kind of having more units of your share, but the dollar value still remains the same in terms of portfolio overall total value. But let's say, example, you had a company that you have 5 units of a company, and that 5 units of a company, the dollar value of the share price was $100 per share. So before you had only 5 units. That means for your 5 units at the initial price of $100 per share, you will have, your portfolio will worth just $500 because you just have 5 units. And that company decided to do stock split. After the stock split, depending on the proportion they use, if they use a proportion of maybe 1 for 100, if they do 1 for 100, it means you just do 1 times. You have 5, you just do 5 times 100. You now have 500 units of that share. But the price, your portfolio price will still remain $500. So with the 1 for 100 now, a unit of that share will now start trading at $100 per share. So what it just simply means, just pause back and listen to this. So it's just increase the units, but the value of the share remains the same. So why do companies do this? The major reason they do this is when they want to buffer liquidity, and when they feel like the share price of their company is too high. So to encourage average everyday retail trader to participate, let them not see that it is too cheap, it's too costly. So the company decides to split their share to encourage more people to join. So it's just a psychological game, because there is this tendency in the market that when people see that something is costly, they tend to shy away from it. So when you split, it becomes cheaper. So is there any disadvantage to it? The only disadvantage is the cost, because there is a cost attached to it, the mechanicals attached to it, the investment bankers, the books they are going to rewrite, the restructuring of the listing, just the cost. That's the only disadvantage. If not, it has the other ones have the advantage. It buffers liquidity. It makes the average investor want to buy. So let's show you an example of some of the recent stock splits. As I'm making this video, this is 2024 August. A company called Nvidia did stock split. Nvidia is under this thing, under technology company AI narrative. That's what is driving the price of Nvidia. So they are a kind of the pioneer of the AI stuff at a time. So Nvidia did a stock split. Then by the right, we have Apple. Apple did their own in 2020. So the proportion, like we discussed initially, Nvidia did their own 10 for 1. So for every 1 share you had in Nvidia, you receive extra 10. So it's like stock bonus. Some people call it stock bonus. Where we have the opposite, which is stock buyback or reversal stock. Yeah, the real opposite is reversal stock split, where companies now tend to reduce the number of outstanding shares in the market. So Nvidia was 10 for 1. So for every 1, you receive extra 10.